Opendoor stock closed Wednesday's session down 26 cents, or about 3.4%, to finish the day at $7.38 per share. The stock spent most of the day bouncing between green and red territory, before late session selling pushed it lower into the close. Now, if you've been following Opendoor for the past few weeks, you know this kind of sideways action isn't new. The stock has been trading inside a narrow range between roughly $7 and $9 for close to a month now. There have been pops of strength, some days of weakness, but overall it's been a picture of consolidation. And while some traders get impatient during these periods, for long-term holders, this is often exactly what you want to see. Sideways markets build pressure. They let the weak hands shake out. They allow institutional buyers to accumulate positions quietly. And they create the foundation for the next leg higher. That's what seems to be happening with Opendoor right now. The company isn't making wild moves, and it doesn't need to. The key catalysts, the ones that could truly reshape how investors see this business, are still ahead of us. We're now just 2 weeks away from the next Federal Reserve interest rate decision on October 29th. That meeting will set the tone for the housing sector through the rest of the year. We've already seen signs of cooling inflation and softer labor market data. The market is starting to price in the idea that the Fed could hold steady, or even prepare the groundwork for a further rate cut before year's end. That's important, because lower borrowing costs flow directly into stronger housing demand. Mortgage rates, which had pushed toward historic highs earlier in the year, have been gradually easing. The 10-year Treasury yield has drifted lower. And as we saw with Jerome Powell's dovish comments earlier this week, the market is beginning to sense that the tightening cycle is done. For Opendoor, that macro shift is massive. Every percentage point change in mortgage rates can unlock tens of thousands of new potential buyers. It changes affordability. It changes seller motivation. And it changes the volume of transactions in the market, which is Opendoor's lifeblood. Next week, we'll also get the September housing data report on October 23rd. The August numbers already showed improvement, with stronger than expected home sales and signs that inventory levels are finally stabilizing. If September's report continues that trend, it could add more weight to the idea that the housing market is bottoming out, and that would be a positive backdrop for Opendoor heading into earnings. Speaking of earnings, we're now only about 3 weeks away from Opendoor's next quarterly report. And this one is going to matter a lot. It's the first full earnings cycle since Kaz Nejatian took over as CEO. Even though he only stepped in toward the end of the quarter, it's clear from his communications that he's already setting the cultural and operational tone for the company. Earlier today, Kaz posted an update on X about the upcoming earnings call, which is calling Open House. The name itself says a lot. Instead of treating it as a closed-door corporate event, he's trying to make it feel participatory, a conversation between leadership and the shareholder base. He even invited investors to share questions and feedback about what they want covered. That might seem like a small thing, but it's actually a big deal. Because it shows that Opendoor's leadership understands the value of its loyal retail investor base, the same community that stuck with the company through dilution, bad press, and volatile market conditions. Kaz is leaning into that loyalty rather than shying away from it. He's also clearly aware that retail investors often feel left out of the conversation, especially when the financial media continues to paint Opendoor as a meme stock. The Wall Street Journal and Barron's have both taken shots at the company in recent weeks, dismissing it as hype rather than substance. But the reality is very different. While the press keeps recycling skepticism, Opendoor has been quietly transforming its operations. Kaz and Keith Rabois have been rebuilding the company from the inside out, focusing on cost discipline, AI automation, and long-term efficiency. We've seen glimpses of that transformation already. Kaz recently revealed that Opendoor's procurement team has been using internal AI tools to identify and cancel redundant software contracts, saving the company millions of dollars annually. That's not just cost-cutting, that's systems thinking. It's about creating a culture of optimization, where data and AI aren't just buzzwords but tools that drive real financial results. It's easy to underestimate the power of those kinds of changes in the short term. They don't immediately show up on a headline or in a single quarter's numbers. But over time, they accumulate. They make the business more resilient. They prepare it to scale when the macro environment turns in its favor. And the macro is starting to turn. The housing market, which had been frozen for much of the year, is beginning to thaw. Builders are reporting better traffic. Mortgage demand is ticking up slightly. And with each passing month that rates stabilize, more homeowners are gaining the confidence to list their properties. That creates opportunity for Opendoor, because its entire model is built on making the process of selling faster, simpler, and more predictable. Think about it. In a high-rate environment, sellers are cautious. They don't want to sit on the market for months, and they don't want the uncertainty of contingent offers. Opendoor provides certainty. And as macro headwinds ease, that certainty becomes even more valuable because it allows people to move quickly again. The next few weeks are going to be crucial. The combination of the housing data, the Fed decision, and the earnings call will likely set the tone for how investors value Opendoor going into the end of the year. And here's the thing, expectations are still low. Last quarter, the company's guidance was conservative. Management was realistic about the challenges in the housing market and didn't overpromise. That means the bar for outperformance is actually quite achievable. If we see even modestly better transaction volume, improved gross margins, or signs that inventory is moving faster through the pipeline, it could be enough to trigger a re-rating in the stock. That's the kind of setup smart investors look for, when sentiment is subdued, expectations are low, and catalysts are near. We're already seeing prominent investors like Anthony Pompliano and others publicly express their conviction. Pomp himself said he added to his Opendoor position during the recent dip, calling it one of the most asymmetric risk-reward setups in the market. And he's not alone. More institutions have disclosed new or increased positions in Opendoor in recent filings, quietly betting that this transformation story will eventually catch on. So yes, the price action may look boring right now. But in the stock market, boredom often comes before the breakout. Consolidation is not failure. It's preparation. Look at how companies like Carvana and Palantir traded before their major runs. Long stretches of sideways movement, fading volume, followed by explosive breakouts once sentiment flipped. The market is often slow to recognize turnarounds, but once it does, the move tends to happen fast. For Opendoor, the structure is there. The story is improving. And the catalysts are lining up. The biggest shift may not even be about numbers, it's about narrative. For months, the conversation has been dominated by skepticism and negativity. But as leadership continues to communicate openly, as the community becomes more engaged, and as the company executes operationally, that narrative will begin to change. Investors love comeback stories, and Opendoor has all the ingredients: a new leader with vision, a core business that works, and a huge total addressable market that remains largely untapped. The U.S. housing market is a $20 trillion ecosystem, and less than 1% of it currently moves through iBuying or digital transaction platforms. That means even small market share gains translate to billions in transaction value. If Opendoor can capture even a fraction of that in a more favorable rate environment, it has room to grow far beyond where it trades today. So yes, the stock closed lower on Wednesday. But the real story is that it continues to hold structure, attract attention, and sit on the launchpad of multiple catalysts. When markets drift, the disciplined players focus on positioning. They think weeks ahead, not hours. And right now, those who understand Opendoor's longer game are doing just that, watching, waiting, and quietly building positions. Kaz Nejatian's quote from earlier this week says it all: "We're hosting an open house." That's not just about earnings. It's a metaphor for the company's direction. Opendoor is opening its doors again, to investors, to innovation, and to the next chapter of its growth. The foundation is being laid, the environment is shifting, and the story is still very much alive. The stock may have dipped today, but in the grand scheme, this is just part of the accumulation phase, a necessary calm before the next move. Because once the catalysts hit, and once the market starts to believe again, the door that's been standing half open might just swing wide. And those who are patient during the quiet weeks will be the ones already inside.